Sir, you can start, sir.
Yeah. Good evening, members. I'm CA Mupal Subara, Regional Council member. I will session on accounting standards for non-corporate entities. By CA Shashank Srivasthan. Shashank Srivasthan is a commerce graduate and law graduate, and is a chartered accountant in practice for the last 3 years. He has exposure in various audit and assurance engagements in various sectors, like manufacturing sector, including manufacturing of iron and steel sector, automotive and automobile sector, etc. Banking sector, including centralized statutory of national banks, service sector, including software services, HR consultancy, advertising, medical services, such as a doctor, mutual fund and agencies, education institutions, religious institutions, charitable organizations and NGOs. He had done his authorship training in Suri and Co., an esteemed firm in Chennai and Company. He is also a graduate in first class in BCom from Madras University and LLB from the Venkateswara University, Tirupati. Areas specialized by Shashank Srivasthan includes accounting standards, Indian accounting standards, financial reporting of entities, bank audit and direct taxation. He is currently a co-opted member in Expert Advisory Committee of ICAI. He is part of task force of ICAI representing to Ministry of Finance and the Central Board of Direct Tax and Infosys for resolving income tax e-filing portal errors. He was the representative from Southern India Regional Council of ICAI. He has also assisted various authors in publication of books relating to accounting and taxation, including podcast publications for the last 2 years. He is also a speaker of various continuous professional education programs conducted by ICAI on accounting standards and Indian accounting standards and income tax. He is a lecturer in various institutions in field of accounts, finance and taxation. Other than this, Shashank is an avid quizzer who has various notable quizzing achievements, including the 3rd place in the Young World Quiz competition conducted by the Hindu. Shashank also has a keen interest in sports and has played district level basketball. He is a consistent performer in academics and was awarded as the best all-rounder award from his school, Padma Sheshadri Bala Bhavan, Chennai. In this brief, I introduce Shashank to this guest gathering, and I request Shashank to go ahead with his speech on accounting standards for non-corporate entities. Thank you, sir. Thank you very much.
So thank you, Subbarao sir, for the lovely introduction. It is my pleasure to be addressing in SIRC once more in the same topic of accounting standards for non-corporate entities. My first address in SIRC was relating to accounting standards for non-corporate entities. I'm glad that SIRC has called me again to talk in the same topic. So before I start the session, a lot of people, before I just share my screen. So before I start my session, a lot of people had asked me. Shashank, you have done this presentation in 2021 January 2021 post-tax audit. You had done a presentation on accounting standards for non-corporate entities. Again, 2 years later, you're doing the same presentation for accounting standards for non-corporate entities. What is the reason behind the same? What logic is there? Why are you doing the same presentation again and again? In January 2021, the rules for accounting standards of non-corporate entities were different. Today, as on date, Institute in their 400th council meeting, 400th central council meeting, had changed the accounting standard compliances and also brought a standardization and regularization of MSME sectors into non-corporate accounting. So accounting for non-corporate entities, they have brought a standardized structure for MSMEs as well as large scale. So they have just split the accounting standards. So today, the overview, what we are going to see is why this is a very important topic. So what is the role of auditors in compliance with accounting standards? So the first thing we will be seeing is what is the role of auditors in compliance with accounting standards. Second, if I do not comply with accounting standards, where I would be caught in my ICAI code of ethics, where I would be caught in my ICAI code of ethics. Earlier, then composition of business and assessees in India, just to understand who are more types of entities there in India, whether the corporate entities are there in India or the non-corporate entities are there in India. Next one, what we will see is old MSME definition versus new MSME definition. Why? Because the new accounting standards compliance. So earlier there used to be 3 entities. Now there are 4 levels of entities. Why that change has happened is because of the change in MSME definition. Then we will see what are the level 1 non-corporate entities, what are level 2 non-corporate entities, what are level 3 non-corporate entities, and what are level 4 non-corporate entities. Then we will see what are relaxations for, what are fully applicable for level 1, level 2, level 3, what are not applicable for level 2, level 3, and level 4, and what are relaxations given for level 2, level 3, and level 4 entities. Apart from that, I will try to relate our tax audit with our accounting standards. Why? Because a lot of assessees, a lot of chartered accountants, more than having corporate assessees as their clients, they will have non-corporate assessees. Whether in tax audit, whether I should file with accounting standards or not, you should comply with accounting standards. Other than that, what are the additional requirements as per council requirements? And for charitable trust, whether I should follow accounting standards. So a lot of publications are there in institute which are going to define what is going to be there in accounting standards. So in my humble beginning, what is going to be the role of auditors? What is the role of auditors in compliance with accounting standards? So first thing you have to remember, first thing as auditors we have to remember, manager's responsibility, the management's responsibility is to ensure compliance with accounting standards, So financial statements are prepared by the management. Also, accounting standards compliance should be done by the management. It is not the auditor's responsibility to follow the accounting standards. It is the management's responsibility to follow the accounting standards. So accounting standards must be followed as per management. Management should follow, not the auditor. The auditor, what is his stance is, he shall form an opinion on the financial statements and report any non-compliance, if any, with accounting standards. So auditor's duty is to form an opinion and report any non-compliance. Management should prepare the financial statements and comply with our accounting standards, whereas auditor's duty, he has to express an opinion. So generally, non-corporate entities, you may not have an audit report. As per SA 700, you may not have an audit report. Where you will have an audit report is generally you will be following in your Form 3CA, Form 3CD. In your tax audit report, you would be having that compliance. So Form 3CB, 3CD, there you will be expressing an opinion in your financial statements. 3CA, it will be already audited in some other act. 3CB, you will be expressing alone in financial statements. So that you should be very careful in reporting that non-compliance. What are the legal requirements? What are the legal requirements for the companies? Statute governs certain enterprises require enterprises management that financial statements should be prepared in compliance with accounting standards. So there are statutory requirements to comply with accounting standards. For example, Companies Act requires you to comply with accounting standards as per Section 133 of Companies Act. IRDA Act requires, IRDA regulations require entities to prepare financial statements in accounting standards. So you must, that is, you must means the management must prepare the financial statements in compliance with accounting standards. In fact, for a larger entity with a net worth over 250 crores, if Indian accounting standards are applicable for non-corporate entities, you must follow Indian accounting standards for the same. Even if it is for corporate, non-corporate, Indian accounting standards should be followed for non-corporate entities. It is not like earlier clauses where level 1, level 2, level 3 Ind AS is not applicable. We have updated our accounting standards. We have updated our accounting standards. We have updated our compliance procedures in relation to accounts. All this is fine, Shashank. All this is fine. What if I do not prepare? See, as per income tax, I have to follow ICDS. As per income tax, I have to prepare financial statements, express my opinion. If it reflects true and fair view, why should I follow accounting standards? If you do not follow accounting standards, there are lot of disciplinary cases that can be faced based on our code of ethics. That is the main reason you should follow your accounting standards. So three clauses of your professional ethics, you will be facing severe punishment. Severe punishment. Second schedule has severe punishment, which may make you lose your membership number. So that much compliance. You may lose your certificate of practice if you are in non-compliance of second schedule. So clause 5, 6, 7 of second schedule will have non-compliance. So what are the non-compliance? What happens if you are non-compliant? How are you non-compliant as per professional ethics? A chartered accountant in practice shall deem to be guilty of professional misconduct if he fails to disclose a material fact known to him which is not disclosed in a financial statement, but disclosure of which is necessary making such financial statement where he is concerned with financial statement in a professional capacity. So if he fails to disclose a material fact known to him which is not disclosed in a financial statement, but disclosure of which is very necessary for financial statement in a professional capacity, he is in non-compliance of accounting standards. He's in non-compliance of code of ethics. So he must, if there is any material fact known to him, it must be disclosed. So compliance with accounting standards is a material fact known to auditor. You must follow accounting standards for non-corporate entities. For non-corporate entities, you must follow accounting standards. Non-compliance with accounting standards is a material misstatement as per SA 320. So as per SA 320, if you have not followed accounting standards, it's a material misstatement. Suppose you have not disclosed that material misstatement, that management has not shown the error in accounting standards, it is a non-compliance on your part. It is a non-compliance on your part. So kindly be very, very, very careful. Be very, very careful on the compliance of accounting standards. So you should comply with accounting standards and report on that accounting standards. As auditor, you must report what are the non-compliances on accounting standard. What you have complied, what you have not complied must be reported in accounting standards. If anything is material in nature, non-compliance in accounting standards is material in nature, you should disclose that in your audit report. Sir, where shall I disclose? Shashank, where shall I disclose? Please disclose in 3CB. You have comments, observation and qualifications paragraph. As per para 3 and as per para 5 of 3CB, you shall disclose that particular criteria. Please be very, very cautious. If you have not done this, very, very crucial. From now on, please comply with a non-corporate, accounting standards for non-corporate entities, or else it is a big non-compliance. Second item is clause 6 of part 1 of second schedule. So again, this is also a non-compliance of clause 6. So you may be guilty in clause 5, clause 6, as well as clause 7. 3 different clauses at the same time. Either of the clause or all the 3 clauses put together, you shall be guilty of professional conduct. So what does clause 6? How are you in non-compliance as per clause 6? A chartered accountant in practice shall be deemed to be guilty of professional misconduct if he fails to report a material misstatement known to him. So I told you, the previous one is material fact. So compliance with accounting standards is a material fact. If you have not complied with accounting standards, it's a material misstatement known to him that appears in a financial statement in which he is concerned in a professional capacity. So this clause refers to failure of part of member to point out in his report that material misstatement appears in the financial statement and he has knowledge of the same. So if you are not complying with accounting standards, there shall be material misstatement. So before going to the next clause, clause number 7. In clause 5, material fact you are not following. Clause 6, you are not doing material misstatement. How to prevent all that is have a proper documentation system of accounting standards. So there is a disclosure checklist given by ICAI. There is a quick referencer for micro companies. There is a technical guide for preparation of financial statements, which tells what all are there for, which also tells the applicability of accounting standards. All of these presentations and resources have been shared by me at the end of my presentation. So kindly check all those particular categories and areas before complying with accounting standards. The next one is clause 7 of part 1 of second schedule. When a chartered accountant will be guilty of professional misconduct. A chartered accountant will be deemed to be guilty of professional misconduct if he does not exercise due diligence or is grossly negligent in the compliance of his duty. So while expressing opinion on financial statement, it is a duty of the auditor to ensure that compliance of accounting standards is as prescribed by ICAI is done. So you should comply with accounting standards. If you have not complied with accounting standards, you are grossly negligent. You are not following that particular clause. You must follow accounting standards. Accounting standards is the first basic Bhagavad Gita for auditors. Then only once financial statements is prepared, the next Bhagavad Gita we will be reading is standards on auditing. Then only income tax law. In relation to financial statements, in relation to expressing an opinion on financial statements, first you should ensure that financial statements follow accounting standards. Then for doing your audit test and audit procedure, you should ensure that standards on auditing is complied. Then only you will be having your financial statements is final. Based on that, you will be doing your tax audit report. This is what is the order of conducting our audit. But what do we do is, client comes in the last minute. We directly prepare a tax audit report. Do not bother whether accounting standards is followed. Do not comply with auditing standards and express an opinion. This practice must be changed. The next clause is, if the same of accounting standard has not complied, if accounting standards is not complied with, it is deemed that auditor has not exercised due diligence in his professional duty and is grossly negligent. So see how a big problem it is. Suppose you do not follow accounting standards. First problem is you knew a material fact that accounting standards must be complied, but still that material fact is not presented in the financial statements. In your professional capacity, you are having a misconduct. There is a misconduct on the part of the chartered accountant. Part 6, clause 6 says, if there is a material misstatement, so SA 320 tells non-compliance with accounting standards is a material misstatement. Suppose you have not commented on the material misstatement, then you are again grossly negligent. Then again you are of misconduct. So clause 6 also you will be caught. Clause 7 you would be caught if you do not exercise due diligence or grossly negligent in your professional duties. So if you have not complied with all the three, be very, 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 very careful. You have to be careful while compliance with accounting standards. So first compliance is as per accounting standards. So for companies, everyone follows accounting standards. Why? Because it is mandated by law. Section 133 of Companies Act mandates that all companies must follow accounting standards. Now it is updated to Accounting Standards Rule 2021. Indian accounting standards must be followed for company and unlisted company or NBFC with net worth greater than or equal to 250 crores or holding or joint ventures of above. Before going to my next slide, what is the Constitution of India? Generally, Form 3CA, this is an old database. After this 2021, very less database is given. So you have a compliance. Form 3CA, there is compliance of 288,000 entities. So corporate entities, tax audit cases, or wherever there is another statutory audit. So LLP Act also you require. So company and LLP maximum tax audit cases is 288,000. Now it is increased to 3 lakhs or 3.5 lakhs. And your Form 3CB, 3CD, which is for non-corporate entities. You have around 30 to 40 lakhs members. So 30 to 40 lakhs members you have for non-corporate entities. So you must follow tax audit for non-corporate entities. So where it is told, sir, accounting standards where to follow for non-corporate entities. Shashank, where it is told, all this you can tell Ambak, where it is told there is an ICAI publication. So every month we receive a chartered accountant magazine in January 1994 issue. This issue is an issue which is older than me, but still it is applicable even till date. It is almost 30 years since the issue of this particular application standard, but it is still applicable till date. So what is the application is accounting standards also apply in respect of financial statements audited under section 44AB of income tax. Accordingly, members should examine compliance with mandatory accounting standards when conducting such audit. So we will discuss what are the mandatory accounting standards as per new policy. There is a new policy. We will see what are the mandatory accounting standards which need not be complied with, and what are the relaxations for accounting standards. All these criteria we will see in greater detail as we go on through the session. So the next item is, who are the non-corporate assessees? Who are the non-corporate assessees? All of us, as in practice, generally express in non-corporate assessee only in tax audit. So where the non-corporate assessees is defined in Income Tax Act is person definition. In person definition, an individual, a HUF, a Hindu undivided family, a firm, an association of person, a local authority, and every artificial juridical person not falling under the various preceding subclauses, they are all non-corporate assessees. So company is a corporate assessees. Apart from that, various other person definition are all non-corporate assessees. So for the purpose of this clause, an association of person or body of individuals or local authority or artificial juridical person shall be deemed to be a person, whether or not it was formed or established with the object of deriving income, profit, or gains. So this is the explanation given. So any entity is considered as person in income tax definition, whether or not they are having profit or loss, profit or gains, whether or not they are incorporated for profit or gains. So all these assessees are non-corporate entities. The next item, what are the type of non-corporate entities as per council decisions? So as per council decisions, very similar to your Income Tax Act, ICAI also prescribes who are the non-corporate entities. Where it is prescribed is May 1991 Chartered Accountant reference. So 32 years ago. Still it is applicable now also. So what are the non-corporate entities are? Sole proprietary concerns, individuals, partnership firms, societies registered under Societies Registration Act, trust, HUF, Hindu undivided family, and association of person. Same definition what is there in non-corporate assessee. The same definition is there here. Only thing that is left off is local authority. Only thing that is left out is local authority and artificial juridical person. But generally our trust and societies will come under artificial juridical person. So all these entities are non-corporate entities. So for your tax audit, as per Chartered Accountant 1994 issue, January 1994 issue, they have told that it is mandatory to follow accounting standards. As per Chartered Accountant May 1991 issue, they have given you all the non-corporate entities, sole proprietors, partnership, societies, trust, HUF, AOP, all these entities are non-corporate entities. Before going to the compliance, let us see what are the various other issues. So ICAI at its 400th meeting held on March 19, 2021, considered the applicability for accounting standards. So consider the applicability of accounting standards to non-corporate entities. So 400th meeting, 4th century annual meeting, 4th century meeting. So on March 18 to 19, 2021, they rechanged the scheme of accounting standards for non-corporate entities. Why so? Shashank, why so? For this, we have to go to June 2020. 1st June 2020, during COVID period, our Honorable Finance Minister had made a lot of changes in policies. One of the major change in policy was redefining what is a micro, small and medium entity. So the major thing that was done is redefining micro, small and medium entity. Earlier, micro, small, medium was different for services, was different for manufacturing. Trading entities were not MSME. Whereas now we got a standardized definition for MSME, whether they are there for services, whether they are there for trading, whether they are there for manufacturing. Just like our GST was standardized for taxation, same way MSME was standardized. A new portal, Udayam, also came for that particular reason. So there they have defined what is a micro enterprise, what is a small enterprise, and what is a medium enterprise. The same logic has been used by ICAI. I will show how. So micro enterprise, who is a micro enterprise is investment in plant and machinery does not exceed 1 crore. So less than or equal to 1 crore. Turnover does not exceed 5 crores. So less than or equal to 5 crores. So both the conditions should satisfy. Investment in plant and machinery should be less than or equal to 1 crore, as well as turnover should be less than or equal to 5 crores. Anything more than investment more than 1 crore or turnover grow more than 5 crores, go to the next size of entity, which is a small enterprise, So from micro enterprise, it goes to small enterprise. So from one entity to next entity, it jumps up. How does it jump? A small enterprise is where investment in plant and machinery does not exceed 10 crore. So from 1 crore to 10 crore investment, it will come in small enterprise, and turnover of 5 crore to 50 crore will come in medium enterprise. Kindly remember all these definition because it is going to be useful when we see the definition in ICAI's guidelines for accounting standards. To see level 1 entity, level 2 entity, and level 3 entity, and level 4 entity. To see these guidelines, we will correlate. So kindly remember these points. The next one is a medium enterprise. Who is a medium enterprise is where investment in plant and machinery does not exceed 50 crores. So from 10 crore to 50 crores investment, it will be considered as medium enterprise, and turnover should be from 50 crores to 250 because turnover does not exceed 250. So from 50 crores to 250 crores, it's a medium enterprise. So this notification is effective from 1st July 2020. So ICAI has to form policies. So it will take around 6 months. First, the Accounting Standards Board should think, based on this policy, how do I update my accounting standards for non-corporate entities? Second thing, they have to have a study group, all multiple groups they have to do, see whether understand. So a lot of members, they would be forming part of the study group thinking, what should we do to improve the accounting standards? How we can standardize based on this MSME definitions. So all that took place, all those deliberations took place, and finally the council passed. After Accounting Standards Board passed, council passed in its 400th meeting to define accounting, to define non-corporate entities. So my last meeting was in January 2021. That time the definition was different. This time the definition is going to be different because March 18th and 19th, they have deliberated and changed the definition of what? Non-corporate entities. Level 1, level 2, level 3, level 4, non-corporate entities. So effective in respect of accounting period starting from 1st April 2020. So this new effect is from FY 2020 to 21. So this effective date. So background changes from FY 2020 to 21. You are updating your non-corporate entities. So how are you updating is now there are 4 categories. Earlier there used to be 3 categories. Now there are 4 categories. What are the 4 categories is large entities, medium entities, small entities, and micro entities. So level 1 is large. So level 1 is large. Level 2 is medium. Level 3 is small. Level 4 is micro. This announcement is not relevant for non-corporate entities who may be required to follow Ind AS. So those who are required to follow Ind AS who's having net worth greater than 250 crores, they have to go and follow Ind AS. So earlier material covered only small and medium enterprises in relation to previous MSME regime. The current one is updated to micro, small, and medium enterprises. Very sorry. So now let us see what are the 4 types of entities. What are the 4 types of entity? What is a level 1 entity? What is a level 2 entity? What is a level 3 entity? What is a level 4 entity? Also, I will deliberate and compare with the old regime. Old regime, there was level 1, level 2, level 3. New regime, there are 4 levels. Old regime, there are 3 levels. We will see what is the difference between the old level and the new level. So first level 1 entity. What is a level 1 entity is non-corporate entity which falls in one or more of the following categories. If any one of the categories are satisfied, they are a level 1 entity. They are a level 1 entity. First one is if equity or debt securities are listed or in the process of listing in any stock exchange, whether in India or outside India, they are required to follow accounting standards. Each level is very, very important. The level will tell what accounting standards must be followed, what accounting standards need not be followed, what relaxations are there, what disclosure relaxations are there. So a lot of requirements are given. So level 1 entity is going to tell whose equity or debt securities are listed or in the process of listing in any stock exchange, whether inside or outside India, they must fall under level 1. Second one is banks. Banks, financial institutions, and insurance business. Sir, no matter what is their turnover or what is their deposit, they would be forming part of level 1 entity. So the first 2 entities, it does not matter what turnover they do, what investment they do, they will be forming part of level 1 entity. Now, the next one is turnover definition. The next one is turnover definition. All commercial, industrial, and business reporting entities. So commercial means an entity which is doing trade, commerce. So commercial means any entity which is doing commerce or trade. So any activity of business they are doing, commercial it comes. Industrial means manufacturing entities who are forming part of particular industry or processing or manufacturing entities who create something new, industrial. Business reporting is who conduct any business. So commercial is any transaction. So any commercial transaction, they will be forming part of reporting entities. So commercial, industrial, and business reporting entities whose turnover exceeds 250 crores for the immediately preceding accounting year. So turnover exceeds 250 crores. Does this include GST or not? As per accounting standards, you need not record your goods and service tax. So you need not record your revenue with goods and service tax. So this is excluding GST. It is also excluding other income. Turnover does not exclude other income. So anything I told that level 1 entities are large, greater than medium. So as per your classification of medium, turnover shall be up to 250. So if turnover is greater than 250, it becomes a large scale entity. So they are a level 1 entity. Level 1 is large scale. Next one is they shall have borrowings. Here they have given borrowings and not investment in plant and machinery, but the borrowings amount is very similar to investment amount. So all commercial, industrial, business reporting enterprises having borrowings, including public deposit in excess of rupees 50 crores. So there I have given that investment shall be up to 50 crores will be considered as medium. Here, see, up to 50 crores. Here, what we are doing is above 50 crores, in excess of 50 crores at any time during the previous accounting year, they are considered as borrowing. Apart from that, holding and subsidiary entities of any one of the above is called as level 1 entity. So any one of the four, it is a holding company or a subsidiary company, they also must come under level 1 entity. The holding company may have not done any turnover. Their only job is to hold investments. Still, they will form part of level 1 entity. Subsidiary which does no turnover, still they will be forming part of level 1 entity. Only holding and subsidiary. Associate is not used. So holding is someone holding not less than 50%. Subsidiary is not less than 50%. Level 2 entities. Who are level 2 entities? Non-corporate entities which are not level 1. So first they are not classifying. Suppose they have failed the level 1 test, you go to the next test, which is level 2 test. So A grade he did not get. Now whether will he get B grade or not? So let us see. So B mark, B grade, let us see whether he gets. So if he is not level 1 entity, but fall in any one or following categories, any one or more of following categories will be considered as level 2. So level 2 is for medium enterprises. I told medium enterprises level 2. Again, pay very close attention here. All commercial, industrial, and business reporting enterprises whose turnover for the immediately preceding accounting year exceeds 50 crores but does not exceed 250 crores. I have seen this definition somewhere. Engyo Pathamari. Where did I see the definition? Medium enterprises where the investment in plant and machinery does not exceed 50 crore and turnover does not exceed 250 crores. If it exceeds 10 crores or exceeds 50 crores, it comes under medium enterprises. So same definition comes here. Exceeds 50 but does not exceed 250. If it exceeds 50, it goes from small to medium. So that is again here. Again, turnover does not include other income. It also does not include your GST. Apart from that, all commercial, industrial, and business reporting enterprises have borrowings, including public deposit, in excess of rupees 10 crores, but not in excess of rupees 50 crore at any time during the preceding accounting year. They are also considered as medium. So again, in excess of 10 crore, but not in excess of 50. Investment in plant and machinery is given the same way. Investment in plant and machinery does not exceed 10 crores, exceeds 10 crores, but does not exceed 50 crores. Same definition. My dear members, my dear friends, the definition is in excess of 10 crores, but not in excess of 50 crores at any time during the preceding accounting year. Also, again, holding and subsidiary of any one of the above shall follow. Holding and subsidiary of any one of the above shall follow. Suppose level 1 is not satisfied, level 2 is not satisfied, we go to the next category. So A grade, B grade, now we come to C grade. So large, medium, now we come to small. So the same small definition is going to be repetition. Non-corporate entities which are not in level 1 and level 2 entities, but fall in any one or more of the following categories. Again, all commercial, industrial, and business reporting, whose turnover for the immediate preceding accounting year exceeds 10 crores, but does not exceed 50 crores. Again, I am correlating. Micro enterprise, if it exceeds 5 crores, it becomes small, and here 50. They've used 10. They have used 10. There is a reason for that. I will tell you the reason when I compare with my old. When I compare with my old accounting standards regulation before 2020-21, you will understand the reason why this is 10 crores and not 5 crores as per the notification. Be very careful. Here it is 10 crores. It shall not exceed, it exceeds 10 crores and not less than 50. Apart from that, all commercial, industrial, business reporting having borrowings in excess of 1 crore, but not in excess of 10 crores. Again, this will be very similar to micro. 1 crore exceeds 1 crore, not less than 10 crores. See, our guidelines is very, very close to government notification. Our institute, our council members, our accounting standard board members have done a lot of deliberation and thinking before prescribing these accounting standards. Apart from that, holding and subsidiary entities of any one of the above shall be followed. Next one is you have level 4 entities. What are level 4 entities? Non-corporate entities which are not covered under level 1, level 2 and level 3. Non-corporate entities which are not covered under level 1, level 2 and level 3. So they have not covered means in MSME less than 1 crore, less than 10 crores turnover and less than 10 crores turnover and less than less than 10 crores turnover and less than 1 crore investment borrowings. Less than 10 crores turnover and less than 1 crore borrowing. So they are coming under micro entities. So level 2, level 3 and level 4 are considered as micro, small and medium enterprises. They are not respectively, I have not put. Level 2 is medium, level 3 is small, level 4 is micro. So these are the categorization. What was the categorization before FY 2021? So why I am telling before 2021, there is also another reason. All of you have known that now ICAI mandates peer review. Not only if you do not comply with accounting standards, you are not only guilty of professional misconduct, you also will not pass your peer review certificate. Now ICAI mandates peer review certificate for all members who are doing audit for banks or partnership which are having 5 or more members in 5 or more members with 5 or more partners. So partnership firm with 5 or more partners or those who want to do statutory audit of public sector banks, they must comply with peer review. So on or before 1st April 2023, they must comply with peer review standards. So in that, they will question whether you follow accounting standards or not. So in peer review report, you have to give last 3 years financial statements. So you have to give financial statements 1920, 2021 and 21-22. So 1920 has a different policy. 2021 and 21-22 has a current policy which follows the current account level 1, level 2, level 3 and level 4. Whereas the old level will be followed for FY 1920. So I'll just do a quick recap of what is 1920. If you remember level 1, level 2, level 3, level 4 in new standards, it is very easy to remember level 1, level 2 and level 3 in old standards also. How are you telling it? Let us see. So now I hope you remember. So level 1 entity turnover exceeds 250 crores and borrowings exceed 50 crores. Then level 2 entity 50 crores to 250 turnover, 10 to 50 borrowings. Level 3 entity 10 to 50 turnover, 1 to 10 borrowings. Level 4 entity less than 10 crores turnover and less than 1 crore borrowings. So based on this thought process, we will go to the old definition. So prior to 2021, so for 1920, because I have to do peer review, I am just doing a quick recap. At least you have a documentation whether you have followed accounting standards or not. That is very, very, very important. So if you have not done, most of us practically would have followed accounting standards, but we will not document the same. So I request you to see what you have documented and what you have not documented. So before going to that, what was the earlier level 1 entity? Level 1 entity is same listed, banks, financial institution, insurance business. That remains the same. The third one is they exceed 50 crores. They are not given 50 to 250. Now there is a new limit 50 to 250. Before exceeds 50 crores is level 1. Exceeds 10 crores is level 1. Borrowings exceeds. So all commercial, industrial and reporting entity whose turnover exceeds 50 crores for the immediate preceding year comes as level 1. So it is as good as my level 2 entity. What was my level 2 entity? It is covering here. Also turnover in excess of 10 crores, whatever. So up 50 to 250 was my level 2. So here both level 1 and level 2 used to come here in this level 1 definition. In the earlier level 1 definition, both level 1 as well as level 2 entities used to come in the earlier level 1 definition. Also, all commercial, industrial and business reporting enterprises in excess of 10 crores at any time during the preceding accounting year. So again, level 1 and level 2 borrowings there. So above 10 crores is coming in level 2 up to whatever borrowings. So level 1 and level 2 will come even here. Then the holding and subsidiary of any one of the four. So the earlier level 1 covered both level 1 and level 2 entities. Then level 2 entities covered what is level 3 entities. We will see. So earlier level 2 entities are non-corporate entities which are not level 1 in nature and follow in the following categories. Turnover for the preceding year exceeds 1 crore but does not exceed 50 crores. Borrowing in excess of 1 crore but does not exceed 10 crores. So very similar to your level 3. Here 10 crores and 150 crores. Here 1 crore and 50 crores. 1 crore and 50 crores. Holding and subsidiary of above. So very similar. Somewhat similar to remember the definition. Last one is level 3 entities. Now what are level 4 are there in level 3 entities. Earlier it used to cover only small and medium. So there was no micro, small and medium. It used to cover only small and medium entities. Level 2, level 3 entities covered only small and medium enterprises. So it used to be considered as small and medium enterprises. So now what happens in level 1 entity? Why this categorization is important? So from FY 2021 onwards, level 1 entities must comply with all accounting standards. Level 1 entities must comply with all 27 accounting standards. There is only 27 accounting standards, yes. From AS1 to AS29, there are 27. How 2 accounting standards have been removed? AS6 for depreciation has been included in the definition of AS10. So depreciation has come in AS10, property, plant and equipment. And as per accounting standards rules 2016, as well as accounting standard rules 2021, they have come in according to that. And then research, AS8 has been removed. Research and development expenditure, it comes in AS26. So they've just merged AS6 with AS10, AS8 with AS26. So those compliance are there. Certain exemptions, relaxation provided to level 2 and level 2, level 3 and level 4 entities. So certain relaxations are given for those entities. So what are the relaxations? Before going to that, we'll just have a small comparison of level 1 and level 1. Earlier level 1 you had exceeding 50 crores, here exceeding 250, exceeding 10, exceeding 50. Whereas bank, financial institution and insurance remain the same. Entities whose equity are, here equity or debt securities is listed, here just securities, updated. Maybe equity, debt, preference, all the securities which are listed in any stock exchange. Holding and subsidiary, holding and subsidiary. The next one is non-corporate entities which are not level 1. Which are not level 1 come into level 2. Here you see 10 crores to 50 crores. Here you see 50 to 250 crores. Here commercial bank borrowings, you see 1 to 10 crores. Here you see 10 to 50 crores. Holding subsidiary of the same. Then level 3, if they are not covered under level 1 or level 2, they are level 3. Whereas here level 3 has one more, 10 to 50 and deposit in 1 to 10. Holding and subsidiary of any one of the above shall be considered as so 2 to 10, 2 to 10 and previous year turnover. So previous year turnover. So just a quick chart. Existing earlier clauses were like this: large, medium, small. Now you can see large is greater than 250, 250 to 50 to 250 is medium. This is turnover. 10 to 50 is small, up to 10 is micro. Here borrowings, earlier it was 10 greater than 10, 1 to 10 up to 1. Here greater than 50, greater than 10 up to 50, greater than 2 up to 10 and up to 2 crores will be considered as classification of non-corporate assets. So these are the classifications of non-corporate assets. So before going to the accounting standards, what all are applicable? What are applicable? What are not applicable for the entities. What accounting standards are going to be applicable, what are not applicable. This beautiful chart is going to tell me what are applicable and what are not applicable. For level 1, all 27. For level 2, 16. For level 3, 12. For level 4, 8. So all these are going to be applicable for accounting standards. We will see what are exclusively not applicable. So exclusively not applicable, you have seen 7 accounting standards are not applicable for level 2. Level 3, 9 accounting standards. Level 4, 11. So 7 will not be applicable for level 2, level 3 as well as level 4. For level 3, 9 accounting standards. Level 4, the same 9 will not be applicable, and additional 2 standards for level 4. AS 15 exemption, we will see what are the exemption in AS 15 and what are the disclosure exemptions for accounting standards for other entities. So we will see what are the disclosure exemptions. So before going to that, we'll just take a small, I'll just take a small 2 minutes break. I'll just be back in a minute.
Sir? Sir?
Sir, 1 second, sir. I'll just.
Okay, okay. Okay, sir.
For the inconvenience, sorry for the inconvenience, I'll just be back. I'm back. What we were doing is the 27 accounting standards. So now we will just go to the other categorization. So what are the accounting standards which are going to be applicable for level 1 entities is all the accounting standards. So now I will just tell a quick brief of how we are following accounting standards. For these accounting standards, usually how we follow the accounting standards while preparing our tax audit report. So while for preparing our tax audit report, how we comply with accounting standards, that we are going to see. First one is AS1, disclosure of accounting policies. So first thing what we have to do in AS1, they have 3 fundamental accounting assumptions: going concern, accrual, and consistency. Generally, going concern we follow. While recording accounts for any non-corporate entity, we follow going concern. We follow that the entity goes on forever. One more thing what we do in AS1 is to ensure going concern is, what do we do to ensure going concern in AS1? To ensure going concern in AS1, what do we do? What do we do to ensure going concern in AS1 is, we record in historical cost of accounting. For Income Tax Act, we don't do fair market value of accounting. We do historical cost. We don't do in realizable value. If going concern is not followed, you have to show realizable value. But what we do in our balance sheet and P&L every year, we show it at historical cost. That itself is an evidence of we are following AS1. Second one is accrual. Shashank, what happens if you follow cash basis? Certain clients follow cash basis. There's an exception given. Our ICAI, there is one guidelines which tells what we need to do when we do cash basis. If you're not following accrual and you're following cash basis of accounting, that disclosure is given in ICAI materials. I'll be sharing it later on. After showing all the compliances and non-compliance, that relaxation I will be showing later on. Third one is consistency. We follow the same policy for our client every year. Depreciation, we follow the same income tax depreciation every year consistently. We follow 43B consistently. We follow all the expenses consistently. If we do cash basis of accounting, we do cash basis of accounting. We do accrual basis of accounting, we do accrual basis of accounting. So this we are doing consistently. We are not changing year from year. If you change year from year, in income tax audit report, clause 14, you will be telling that you have changed the method. Sorry, clause 13, you will be telling that you have changed the method of accounting. Even stock, you will tell in clause 14. If you follow FIFO method, LIFO method, or whatever you are valuing your cost or net realizable value, whichever is lower, all that you will be disclosing in income tax audit report. So you have to follow consistently. If you are not following consistently, that you should report. And what is the impact on profit also you'll report. That is as per AS1. Suppose you change from cash to accrual or accrual to cash, you should tell the impact in profit. There's a disclosure. That we do in AS1 also. So basically, without us knowing, we account for accounting standards. But where we do error as members, so where we do error as members is, we do not disclose in, we do not write the disclosure, we do not write the notes to accounts. You should write notes to accounts for disclosure. So AS1 requires you to write how you have complied with all the accounting standards. So that you must do. Most of the people do not do that. So that you must comply with. So kindly comply with the same. Second one is valuation of inventories. Valuation of inventories. So valuation of inventories, we follow cost or net realizable value, whichever is lower only for finished goods. For raw material, we take only cost. So this is what we take in income tax law also. But we do not disclose. So again, write all the disclosure. You have followed AS2. You have followed AS2 as per income tax law. But you're not disclosing the same. So as per 145, you are following AS2, but you're not disclosing the same. Third one is cash flow statement. This most of us do not follow. Start following cash flow statement. Most of the members do not follow cash flow statement. For a large entity, for a entity which is having turnover greater than 250 crores or borrowings greater than 50 crores, you should disclose. Why? What is the logic behind it? The bank or public financial institution which is giving the borrowings or public who is giving deposit, they should have an idea how the cash, or what is there in financing activity, what is the cash flow from operating, financing and investing, so that they have a knowledge of what error is there, what error is not there. Next one is contingencies and events occurring after balance sheet date. Contingencies and events occurring after balance sheet date, we see whether there is adjusting events or non-adjusting events. So generally, in our income tax AS4 also we comply. Adjusting events are something we know exist on the balance sheet date. Before signing our audit report, if we find that expense I can record. For example, rental agreement. Rent is paid only in the subsequent month. I put a provision for rent based on AS4 and AS29 read together. So I follow that. I am writing all the contingencies, something that existed on the balance sheet date. Partner salary. I know I have to pay partner salary. Most of you would have written partner salary as per, in the partnership deed, it is as per Income Tax Act. So that you have to record. Also, some loss by theft is there. For example, 31st March, in February, there was some item lost by theft, but it was found only in May. That you will record the loss in the year itself when it is incurred as per Income Tax Act. So any loss by theft, you record it in the year where as per Income Tax Act. So that is an adjusting event. It is a contingency, an event happening after balance sheet date. That also you record. That also you record. The next one is AS5. AS5, you follow net profit for the period, prior period item. So any prior period item you disclose. In Income Tax Act, you disclose. In your tax audit report, you disclose any expenses or income which has not prior period income or expenses, you disclose in your tax audit report. So see again, documentation. What is insisted is documentation of the sale. And change in accounting policy, I told cash to accrual, accrual to cash. You are documenting the same. AS6 is not there, omitted depreciation. Construction contracts, it is applicable. And we do follow construction contracts as per ICDS. So ICDS 7 and here it is the same. ICDS 4, sorry, ICDS 4 and AS7, we follow the same for construction contracts. We recognize based on progressive billing. We recognize based on completion. We get a completion certificate in tax audit report. I mean, while doing tax audit, we see the completion that only we offer to income. We do all that, but no disclosure of the same. AS9, we also follow AS9. AS9, we follow when the goods go out only, we record the sales transaction. We see whether there is an e-way bill given. We see whether there is a, we see e-way bill is given, goods go out, there is an invoice, there is a delivery challan. If all these conditions are satisfied, only we include in the turnover as per Income Tax Act. Management includes that. Auditor also accepts only that. If they have not given an e-way bill, only invoice is there, auditor does not accept. Same way, risk and reward is transferred, then only we recognize revenue. That is what we are doing as per AS9. Where we do non-compliance, it is not shown in, record. It is not shown in documentation. You should document how you follow AS9. AS10, you follow property, plant and equipment. The capitalization in Income Tax Act is the same as per AS10. You capitalize the cost. You capitalize any incidental expenses to bring to current location or current working condition. You capitalize what are those incidental expenses? Transportation cost from seller place to buyer place, any installation cost, any technical cost, all that we include as per AS10. Even GST, which is non-refundable, we include GST, which is non-refundable along with the cost of the asset. For example, motor car you purchase, you cannot avail GST credit. We add it to our value because it's a non-refundable duty. This shall be recorded that you are following the same. Next one is AS11, foreign exchange fluctuation. So for monetary assets, for your debtor and creditor, you record the foreign exchange fluctuation. For AS11 for fixed assets, if there is any change in the valuation of fixed asset, we do follow section 43A. 43A for as per Income Tax Act you follow. Here, as per AS11, you record at a historical cost. So there is a distinguishment there. There we should be very careful. Also, monetary asset, that is debtor, creditor, any forex currency you are having, restate it at the end of the year. This you will not do if you follow normal accounting standards. If you follow just income tax, as per accounting standards, you need to restate all these items. Government grant we are following. AS12. How, sir? Revenue government grant. How Sashank? Revenue government grant, you show it as income. Whereas any capital government grant or subsidy given, you reduce from your cost of acquisition. In your depreciable asset. So as per section 50, in the depreciable asset, you reduce the cost of acquisition. We do follow this. My dear members, all these things we follow. But what we don't do, we do not record the same. This is where our quality goes up. So Audit Quality Review Board, tells the major problem in chartered accountants firm is they follow standards on auditing, they follow accounting standards, but sadly they do not do a disclosure of how they followed. This is what is required in compliance. Next one is accounting for investments. So you should record investments or cost or fair value, whichever is lower, if it is held for trading. So if it is held for trading or if it is short-term investment, current investment, you will do cost or fair value, whichever is lower. Suppose there is a permanent diminution for long-term investment. So long-term investment, you will value at cost. Permanent diminution is permanently the value of stock falls. For example, Lakshmi Vilas Bank stock you had, it permanently fell. Then you have to record it at the lower price. You have to record it at the lower price. Vodafone Idea, you purchase for 100 rupees. Today it is 15 rupees. Permanent diminution. Permanent diminution. The fall is not temporary in nature. It is permanent in nature. So that you will be recording as per AS 13. Accounting for amalgamation is included for level 1 entities, but amalgamation used very rarely. They've kept LLP in mind. Why accounting for amalgamation is there is they've kept LLP in mind. That's the reason accounting for amalgamation is there. Employee benefits. So AS 15 must be followed. So you have to get an actuarial valuation for your gratuity, leave encashment, which is given at the time at retirement. These employee benefits. So you have to find the defined plan obligation, defined benefit obligation, reduce your fair value of plan assets. So suppose they are having LIC. So suppose they are having LIC. So they are having an LIC group gratuity fund. So as per 40A7 and 40A9, you should have a recognized gratuity fund. You should have a recognized gratuity fund as per Income Tax Act. Then only the amount contributed for gratuity will be allowed. So recognized gratuity fund. So for that, you have to do actuarial valuation. As per AS 15, you should do actuarial valuation for the same. So we follow 43B and 40A7 and all compliance, 40A9, but we do not follow actuarial valuation for gratuity and leave encashment. That you need to follow. Next one is borrowing cost, AS 16. AS 16 borrowing cost is when an asset is not ready to use. When an asset is not ready to use, any interest, you have borrowed some loan. Suppose you have borrowed some loan, any interest on that borrowing till the date asset is ready to use or asset is capitalized, you will be adding to the asset value. So that interest value, you will be that finance cost or interest, you will be adding to the asset value. So qualifying asset is usually your fixed assets. Your fixed assets, which you will be adding, or property, plant and equipment. Now it's called property, plant and equipment. Earlier it is called fixed assets, where you will be adding that interest value. Why I am telling you this is the same principle is there in tax audit report, interest under section 36(2). Interest under section 36(1)(2). 36(1)(2), you should follow the same. Sorry, 36(1)(3). Interest under section 36(1)(3), you must follow the same. So if interest till the date of put to use, it shall be capitalized, it shall be disallowed. Only interest after the asset is put to use, you can allow it as revenue expenditure. Before put to use, it will be capitalized. 36(1)(3), Income Tax Act. Same logic we are following here. What we do not do, record the same. Next one is segment reporting. Split into reportable segments. You split into reportable segment based on business segments or financial, based on location or the commitment. So 10% of revenue from operation, 10% of result of profit, or 10% of investment. So that you will be saying based on sector or location. So I'm having multiple sector, I have to do segment reporting. So I am doing multiple products, segment reporting, or I'm there in multiple location, I have to do segment reporting if I qualify any of the 4 categories. Then AS 18, related party disclosure. This I follow. But there is a difference between AS 18 and 48(2). Certain related parties are there in Income Tax Act, but it is not there in, certain parties are there in AS 18, not there in Income Tax Act, and vice versa. So AS 18 also I follow. Related party disclosure, I follow. Then leases. Leases, what I do is again, finance lease, operating lease. Generally, operating lease, I revenue. So any rent payable monthly Operating lease, we expense off. We expense off. The management expense off, the auditor considers the same. But, and finance lease, any lease over 12 years, a long time period, we consider it as, we capitalize that asset. Practically, that is what is done by management. It is accepted by auditors because it is followed. Where does that come? As per leases, AS 19 leases, we categorize our finance lease and operating lease. We split what is finance lease, we split what is operating lease. Based on that only, that categorization only, we have our records. We have our records according to that. Next one is earnings per share. Again, earnings per share for non-corporate entities, it's not applicable, but still they have given. Suppose they have a cooperative society gives shares. Association of person has some shares. So members has some shares. For that, this earnings per share is applicable. Consolidated financial statements also applicable. Accounting for taxes on income. So accounting for taxes on income, you have to put profit before tax and after tax. So generally, we do not follow this for non-corporate entities. We do not put profit before tax and profit after tax. We do not put what is profit before tax and what is profit after tax. So that we do not put. This we have to put for level 1 entities. Also, we have to put something called as deferred tax. Kindly record what is deferred tax. If there is AMT credit, that also you must record. So all these 3 compliance you should do. All these 3 compliance you must do. Generally, we do not record what is the tax amount. What is the provision for tax? What is the tax paid? We do not show in books of accounts. But since AS 22 should be followed for level 1 entities, kindly follow the same. Next one is AS 23. Accounting for investments in associates in consolidated financial statements. You must follow AS 23. Next one is discontinuing operations. So any operations you have discontinued. So any operations you have discontinued, the same must be followed. Suppose you want a record, you are submitting to bank some audited financial statement quarterly or some limited review financial statements quarterly as per bank's requirement. You have to follow interim financial reporting, AS 25. If there is any brand, goodwill, patents, or any intangible assets, trademarks, license, any intangible assets are there, you have to follow AS 26. So intangible asset, we provide depreciation for 25%. Amortization is given as per AS 26. Again, documentation we do not do. Impairment of assets, we do not show in our general entity. What we do is, we do not show any impairment. Generally, your property, plant and equipment go through the test of impairment. It goes through the test of impairment. You do write off that particular asset. Whereas as per Income Tax Act, there is no permanent impairment. There is only depreciation. Until the block gets a 0, you will be providing depreciation till that particular time limit. So impairment of assets must be done in books of accounts. So the financial statements you are preparing as per tax audit report, you must prepare impairment of assets. Certain relaxations are there for level 2 and level 3 and level 4 entities. We will see that later. The last one is provision, contingent liabilities and contingent asset. So contingent liabilities we do not disclose. Generally, that has not been disclosed by management, and it is also auditors when they give their audit report, they do not express an opinion on the contingent liability. So contingent liability forms part of financial statements. So any claims against a company or against the non-corporate entity not acknowledged as debts. So your income tax, disputed income tax, your disputed VAT, disputed GST, or any disputed amount with any other entity which is not acknowledged as debts must be shown as contingent liability. Also, any guarantees given by bank must be recorded as contingent liability. Guarantees or letter of credit must be recorded as contingent liability. So kindly make a note of that. And provisions. So provisions we have to follow. If you are following accrual system, if there is certainty of amount, certainty of a collection, if there is a past event and there is a reasonable estimate that can be made, we create provision. So for any rent payable, we have past experience, we have a rental agreement. Based on that rental agreement, we create provision. Audit fee provision we create in accrual system. All this is created, but the same is not recorded. So kindly disclose all these in your accounting standards. We will see certain carve in and carve out of all these overlaps. All these overlaps, we will see certain carve ins and carve out. Next, we will go to level 2 corporate entities. So what are the accounting standards that are applicable? So here all 27 were applicable. Here there is going to be only 16 accounting standards which are going to be applicable in greater detail. So AS1 is applicable, AS2 is applicable, AS3 is not applicable. Cash flow statement is not applicable. Cash flow statement is not applicable. AS4 is applicable, AS5 is applicable, AS6 depreciation is removed, AS7 is fully applicable. So these are all fully applicable. Word to word it is applicable. AS10 is applicable, AS11, AS12 is applicable, AS13 is applicable, 14 is applicable. 15 there are relaxations. So 15 there are relaxations. 17 it is not applicable. 18 is applicable. 19 there are relaxation. Leases there are relaxation. 20 is not applicable. 21 is not applicable. 22 is applicable. 23 is not applicable. 24 is applicable. 25 again not applicable. 26 is applicable. 27. AS27, you have your, sorry, AS27 not there. AS28, you have certain impairment. AS29, you have some relaxations. So AS27 not applicable. AS28 and 29, you are having some relaxation. Next one, accounting standards. So disclosure of accounting policy. So then here only 12 accounting standards are applicable. So 4 more accounting standards are removed from this. So investment amalgamation is removed. Sorry. What is removed is AS18 is removed. AS24 is removed. So discontinuing operation and AS18 is removed. So there are 12 accounting standards: disclosure, valuation, contingency, net profit, construction contract, revenue recognition. AS10 and 11 also there are certain relaxation. Full AS10 and AS11 is not applicable for level 3 entities. Only 12 accounting standards. So from 27 it became 16. From 16 it became 12. So 10, 11 and 24. 10, 11 and 18 and 24 are not applicable for, fully applicable for level 3. There are relaxation for the same. Level 4 entity, there are further removals. What are the further removal if you see is AS13, 14, 22 and 26. AS13, AS14, AS22 and AS26. All these have been removed. So AS1 is fully applicable. AS2 is fully applicable. AS4 is fully applicable. AS5 is fully applicable. AS7 is fully applicable. AS9 is fully applicable. AS12 is fully applicable. And AS16 is fully applicable. So these are the accounting standards which are fully applicable to the entities. After this, what are the accounting standards not applicable for level 2, level 3, level 4? Fully not applicable. Not even one line is applicable for level 2, level 3, level 4. So 7 accounting standards are not applicable for level 2, level 3 and level 4. Level 3 and level 4 to another 2 more. Level 4 another 2 more. So we are going to see 7, 9, 11. I told you not applicable. If you see the chart, 7 is not applicable for level 2. 9 is not applicable for level 3. 4 is not applicable. 11 is not applicable for level 4. So 7 accounting standards are not going to be applicable for level 2, level 3, level 4. They are AS17, AS20, AS17, AS21, AS23, AS25 and AS27. AS27 is applicable. So all these are not applicable. Level 1 entities, if there are some SEBI requirement, they have to comply. That is why these earnings per share, consolidated financial requirement, associate entity, interim financial reporting, joint ventures. Since there are some regulators or SEBI which ask them to comply with these standards, they must comply with the same. Next one, what is not applicable to level 3 and level 4? Fully or not applicable at all. AS 18 and AS 24. Related party is not applicable for level 3 and level 4. So what are level 3 and level 4? Small and medium enterprises, it's not applicable. But Income Tax Act, discontinuing operations or your related party will not disclose, you have to disclose. There is no change in 48.2 and discontinuing operations also. Any losses or gain, you have to offer it to income. You have to offer it to income, but it is given here. So kindly make a note of the same. Then the next one is AS is not applicable for level 4 entities. What accounting standards are not applicable for level 4 entities is accounting for amalgamations and impairment. So amalgamation is applicable a little bit for amalgamation is applicable fully for level 2 and level 3. For level 4, it is not applicable. Amalgamation and impairment. So it is fully not applicable for level 4 entities. Now after this, we will see what are the part compliances. So first exemption given is under AS 10. First exemption is given under AS 10. So what are the exemptions? So what are the exemption is there is a disclosure exemption. Generally, it is a disclosure exemption. So as per AS 10, property, plant and equipment, an enterprise should disclose the following details. It is encouraged. In fact, AS 10 itself is telling it is encouraged. You may follow or may not follow, but encourage. We encourage to disclose the same. So level 1, level 2 and corporate entities are encouraged to follow this. What are the disclosure is? If there is some temporary idle property, the carrying amount of the same shall be disclosed. Also, the gross carrying amount of fully depreciated property, which is still in use, shall be disclosed. For example, lot of non-corporate assessees may have machinery which is fully depreciated as per books of accounts or fully depreciated. But we do have to record the gross carrying amount of the same. You have to record the gross carrying amount. You have to, it is encouraged to disclose. If you know it, disclose. If you do not know it, do not disclose. So you are encouraged to disclose the same. If an asset is kept temporarily idle, that also must be disclosed in the notes to accounts. So generally, apart from your normal notes to accounts, you have to disclose the same. Next one, for each revalued class of property, plant and equipment, the carrying amount shall be disclosed. The carrying amount that would have been recognized under the cost model shall be disclosed. Suppose there is revaluation, you have to tell what is the carrying amount as per cost model before revaluation. So revalued figure and cost figure, you will give a comparison. The last one is if an asset is retired from active use. So it is, that's it. You have stopped using the asset and it is also not held for disposal. That carrying amount also shall be disclosed. So all these disclosure are required for level 1 and level 2 entities and also corporate entities. Whereas level 3 and level 4, these 4 items need not be disclosed. Again, I will repeat, carrying amount of temporarily idle property, plant and equipment need not be disclosed. Gross carrying amount of any fully depreciated property which is still in use need not be disclosed. Any revalued asset, you should do a comparison of cost model and revalued asset model. And retired from active use and not held for disposal if you are having some assets. So I'm having an old asset. For example, I have a laptop for 5 years. Laptop depreciation rate is 40%. Only one laptop I am having in my service. So you are also chartered accountant practice also is a level 1, level 3. It is a level 4 entity, level 3 or level 4 entity depending on the size. So based on that, level 2 is not possible mostly, but level 3 or level 4. So based on that size, we have that particular classification. So if it is not in active use, say laptop I had only one laptop in my practice, micro. I have retired that laptop is fully depreciated. 3-4 years, it will be fully depreciated, 4-5 years. Still, I'm having that laptop. you have to disclose the carrying amount. What is the gross carrying amount? Gross means what you purchased for. Then if it is retired from active use and not held for disposal, the same shall be recorded. The same shall be recorded. After this, AS11 has a disclosure requirement. So I told you level 3 and level 4 has AS10 and AS11 itself is not fully applicable. Why? Because there are some disclosure exemption. What are the disclosure exemption for AS11 in level 3 and level 4 entity is? So this disclosure exemption was there earlier also. This disclosure exemption, we have to see what are the disclosure exemption is. Disclosure is encouraged for enterprises foreign currency risk management policy. Again, this is an encouraged disclosure. This is disclosure which is encouraged to be presented in financial statements. What is encouraged is what policy you are having. What are the objectives of foreign currency risk management policy? How are you managing foreign currency risk? Today, dollar rate is 80. Tomorrow, it will become 88. How are you managing that risk? You are importing goods. How are you managing that risk? You're importing oil. How are you managing that risk? You're importing in dollar. How are you managing that risk? So how are you managing that risk? You have to do some disclosure. What are the disclosure? To manage risk to the budgeted cost and revenue from adverse impact of currency fluctuation. So from 80 to 88, 10% fluctuation. How are you managing that risk? Second one is to reduce the rupee cost of foreign currencies payables by selective hedging of exposure. So suppose you have a payable, suppose you have a creditor payable, you can do something called as hedging. What hedging is? You have a foreign currency receivable. For that payable, you have an equal and opposite foreign currency receivable. That is called as hedging. Suppose you have that hedging, kindly disclose the same. To reduce the rupee cost, what hedging you have done, that shall be disclosed. So $1 lakh I have payable. To prevent, if it becomes 88, it's going to be a loss for the company. To prevent that loss, I hedge. I keep it as receivable. Next one, to achieve results better than what would be passive automatic 100% hedge policy. So you should do what better hedging policies you can follow. Not only payable, receivable. If you are using a better hedging policy, kindly record the same. Then to reduce the cost of funding by raising foreign funds directly or indirectly through approved instruments. So receive foreign funds, foreign borrowings, ECB to hedge. So all that is there. The last one is to reduce transaction cost and bank exchange margins. To adjust all these disclosures, how are you managing this? How are you managing all these items? You should record the same. You should record the same. How are you managing all these items? Shall be recorded. Next one is AS13, investments. Investments. How do you prevent your what recording for investments? So level 4 entity, there is some disclosure exception. What is the exemption for disclosure is other disclosure required by relevant statute. So some investments, if you are required to disclose some, you are required to disclose as per statute. You are required to disclose as per statute some investment criteria. That exemption is given in accounting standards. But here kindly note one thing. My dear members, kindly note one thing. You are expressing an opinion on financial statements. If you do not follow government statute, it is a material misstatement as per SA 320. Even though there is a relaxation as per accounting standards, not to mean any disclosure required under relevant statute, it need not disclose is given. Relaxation is given for level 4. Kindly disclose the same. To protect yourself from clause 5, clause 6, clause 7. Because if you do not disclose any requirement as per statute, it is a material misstatement as per SA 320. You are grossly negligent. You have not applied your due diligence. It is a material fact, material misstatement, clause 5, clause 6, clause 7. All the 3 clauses will be applicable. So kindly disclose the same. Accounting standard, there is an exemption. Accounting standard, there is an exemption. Whereas there is not an exemption in standards on auditing. So apply your mind and kindly do the same while expressing an opinion on financial statements. Now AS15. AS15, I told you there are certain disclosure relaxation. What are the relaxation? what other relaxation is? If there is some short-term compensated leave. So para 11 to 16. So disclosure you have to give for short-term benefits. So we'll see what are the paras. While read them out, we will see what are the paras. So para 11 to 16 of AS 15. What they deal is with recognition of short-term measurement, short-term accumulating compensated absence, which are non-vesting. Non-vesting means they cannot be accumulated, which cannot be accumulated. So that is, employees are not entitled to cash payment for unused entitlement on leave. So that need not be disclosed. So they are not entitled for cash payment for unused required entitlement of leave. Very simple. A company has a policy of giving 15 days leave. 15 days apart from Saturdays, Sundays leave. So if you have a policy where leave will be compensated, you have policy where leave will be compensated every year. So accumulated leaves will be compensated every year. If it is short term in nature, that disclosure is not applicable here. That disclosure is not applicable here. Then para 146 and 139, which deals with discounting of amounts that fall more than 12 months after the balance sheet date, not applicable. What does this mean? In long-term leave encashment and gratuity, when you do the actuarial valuation, you have to discount it to the present value. That is not applicable for level 2 and level 3 entities. Next one, recognition and measurement principles. In para 50 to 116 and presentation and disclosure requirements. My dear members, the same principles were there even earlier. So the earlier 1920 financial statements also, the same relaxations only were given. So 10, 11, 13, there were no relaxation in the earlier 1920, but AS 15, the same relaxation only is given. The third relaxation is recognition and measurement principles in para 50 to 116. So some recognition and measurement principles for defined benefit plans. So long-term plans. So your gratuity plan, your leave encashment plan, you need not do for level 2 and level 3 and as well as level 4. Level 4, I'll tell you what is the disclosure required itself. So you need not follow the same. You need not follow the same. And recognition principles for long-term, other long-term employee benefits, that also you need not disclose. So all these disclosure is not required. So actuarial valuation, you need not do for level 2, level 3, level 4 entity. For level 1 entity, do an actuarial valuation. So what is relaxation given? What is the additional relaxation is given is C note. So for defined benefit plan and 129 to 131, what plan shall be followed is if an average number of person employed during the year is 50 or more. 50 or more, you have to do actuarial valuation. Less than 50, you need not do. 50 or more, you should do actuarial valuation using projected unit cost method. You should do using projected unit cost method. Discount rate shall be done with market yield of government bond. So that only you should follow. You need not do actuarial valuation in any other method. Only this method actuarial valuation shall be done. So actuarial assumption shall be as per para 120 of AS 15. You should follow actuarial assumptions which are given in para 120 of AS 15. The other exemption for level 4 entities as well as less than 50 is you need not even do actuarial valuation. You can use some rational method to compute the same. Entities may calculate and account these items using some rational method. Using some rational method, they can account the same. Next criteria, AS 19. AS 19, these paragraphs are not applicable for level 2 entities. These paragraphs are not applicable for level 3, 2, 3, 4 entities. I have given the paragraph number. We will see those paras in detail in the next slide. So para 22C, 22E and 22F is not applicable. Para 25A, 25B and 25E is not applicable. Para 37A, then 37F is not applicable, as well as 46B and D is not applicable. Whereas here 27, 22E, CEF, 25ABE, 37 A, F and G. Here there are only 2 paras. Here there are 3 paras which are omitted. For level 3 and 4, one more additional para is omitted for level 3 and 4. And here also in 46, an additional para in 46E is omitted. 46B and D it is not applicable. Additional para as per 46E is omitted. We will see what are the paragraphs that are omitted. So what are the relaxations? So what does paragraph 22 tell? What are the relaxations? So 22, all the entities have the same relaxation. What are the relaxation is? You need not do reconciliation of minimum lease payment with the present value. Generally, level 1 entity, this disclosure is required. What is my minimum lease payment and what is my present value as per AS 19 in finance lease? This is applicable only for finance lease. Operating lease, this para 22 is not applicable. This is for finance lease. These are disclosure in relation to finance lease as per AS 19. So you'll be comparing what is the minimum lease payment with the present value. So based on minimum lease payment, you discount it, you get the present value. That reconciliation you need not do for level 2, level 3 and level 4 entity. Whereas level 1 entity, you should show what is the minimum lease payment and show what is the present value. Why? Because in accounts, we record only as per present value. For leases, finance lease, the cost of the asset would be recorded as per the present value and not as per the minimum lease payment. Also, we have to disclose minimum lease payment as on balance sheet date and their present value for each of the following periods. So what is the minimum lease payment? So how much lease should be paid in the next 1 year? Then greater than 1 year, greater than, less than, after 1 year, less than 5 years. And more than 5 years, you have to disclose. So if lease is there for a long time period, less than next year, what is my current lease obligation for the next year? I will record. 1 to 5 years, I will disclose. More than 5 years, I will disclose. All these things will be disclosed. So I am paying a 12-year lease on my car, or 5-year lease on my car, or 7-year lease on my car. First year. So at the end of the first year, second year lease I have to disclose as less than 1 year. Then third year to 6th year, I have to disclose as 1 to 2 to 6 years. So more than 1, less than 5. Less than or equal to 5, I should disclose in that. The 7th year, I will show later than 5 years. This is what I show as disclosure in AS 19. The next one is total of future minimum sublease payments expected to be received under non-cancelable sublease. Lease means you are receiving it as lease from somebody else and that has been subleased to another lessee. So you are a lessee who has leased it out to another sublessee. So lessor has given you some property, you have subleased to another person. So that non-cancelable lease has to be recorded as per level 1 entity, whereas level 2, level 3, level 4, that disclosure is not required. Next one, general description of lessee's significant leasing arrangements, including but not limited to the following, basis on which contingent rents are paid that need not be disclosed. So contingent rent, happening or non-happening of an event, you're going to pay some rent. That is covered in AS 19. So that contingent rent paid, you have to disclose. As per AS 19, that need not be done for level 2, level 3, level 4. Any existence or terms of renewal of or purchase option. So is there any renewal option in lease or purchase option in lease or any escalation option in lease? It should be disclosed for level 1 entity. Whereas level 2, level 3, level 4, you need not disclose the same. The next one is restrictions imposed by lease arrangement, such as those concerning dividends, additional debt, and further leasing. So suppose lease agreement has some restrictions telling that you cannot take additional debt, you cannot take further leasing. That should be disclosed for level 1. Whereas level 2, level 3, level 4 entity need not disclose the same. So this was for paragraph 22. These were the relaxations for paragraph 22. Next we'll see the relaxation in paragraph 25. So we'll see 25 and then I will go to the other paragraphs. So 25 is relating to operating lease. So again, operating lease also you should show what is the lease payable in the next 1 year, 1 to 5 years and later than 5 years. Same thing what you saw in finance lease, same thing you're seeing here. Then Future sublease payment under non-cancelable lease also need not be disclosed for operating lease. The other one which need not be disclosed is general description of lessee significant leasing arrangement. Same thing. Contingent rent, whether there is some renewal option or purchase option, or whether there is some escalation option, or whether there is some restriction. Whether there is some restriction that shall be recorded. Next one is restriction imposed by lease arrangements, such as concerning dividends, additional debt, and further leasing. Same thing which you saw in operate finance lease. Same disclosure relaxations are there in operating lease. Only one point is not there is reconciliation. Obviously, reconciliation will not be there for operating lease. Minimum lease payment to present value will not be there for operating lease, because operating lease you will provide based on that year what has incurred based on the rental agreement. Future lease you will not record in the books of accounts. Whereas here future lease will be recorded at the present value as the cost of asset in finance lease. So that is the distinguishment between finance lease and operating lease. Other than that, finance lease has certain other disclosure, operating lease has certain disclosures. So 37 has certain operating lease disclosure. What are the disclosure for the same? What are the disclosure for the same is, first one is reconciliation between gross total investments and lease at the balance sheet period. Gross total investment and lease at the balance sheet period, you will be doing a reconciliation. You will be doing a reconciliation of item between the gross total investment in the lease period at the balance sheet date and the present value of minimum lease payment. So this is for lessee. Lessor also you will be doing the same. So lessee, you do reconciliation, same reconciliation you will do in lessor. What is the gross investment with the present value of minimum lease payment? So the same disclosure here and here. So lessor is who gives the lease. Gross investment is how much lease is going to receive in the future date. Here, what is the lease payment you are going to do in the future date? So what is the difference between minimum lease payment and gross investment? So minimum lease payment, I will just tell you what is minimum lease payment. Total lease payable as per the agreement, add something called as guaranteed residual value. Add something called as guaranteed residual value. If lessee is telling I'm at the end of the lease, I will pay guarantee amount for scrap, some amount that would be added as amount to minimum lease payment. What is gross investment is minimum lease payment plus unguaranteed residual value. So unguaranteed is over and above the guaranteed amount. Whether lessee or some other party, third party also can tell this much amount I'm guaranteeing to pay. So that is minimum lease payment. Gross investment is unguaranteed residual value you will be adding. So gross investment, what you will be receiving for a period not less than 1 year, 1 year to 5 years, greater than 5 years. That disclosure you will make in greater detail. General description in leasing agreement of lessor, that also there is exception. The last one is accounting policy adopted in respect of initial direct cost. So any initial direct cost you have invested, that is the paragraph which is omitted for level 3 and level 4. So I told 37G is not applicable for level 3, level 4, but applicable for level 2 and level 1. So accounting policy in relation to in respect of initial direct cost, that disclosure you should. Next one is operating lease. So operating lease, again you will not have the reconciliation. Gross investment and present value of minimum lease payment you will not have. Other than that, the same thing. Future minimum lease payment under non-cancelable operating lease in the aggregate and for each of the following periods. Not later than 1 year, what disclosure shall be made? Later than 1 year and not later than 5 years, what disclosure shall be made? Later than 5 years, what disclosure shall be made? Also, you should give the general description of lessor and accounting policy. So all these are relaxations. These need not be disclosed. I'm not telling what should be disclosed. I'm telling what should not be disclosed. Other than that, AS 19 shall be followed. Other than that, AS 19 shall be followed. What shall be disclosed? What shall not be disclosed? we have to see, and other than that, AS 19 shall be followed. Next one, AS 22, only level 4 has a relaxation. Only level 4 has relaxation. What are the relaxation for AS? So level 4 is current tax. It shall apply AS4, only level 4, only these provisions are applicable. Current tax is the amount of income tax that you shall record. Tax expense for a period comprising of current tax and deferred tax shall be included in determination of net profit. That shall be done. Next one is current tax shall be measured at the amount expected to be paid or recovered from taxation authorities using applicable tax rates. So current tax and deferred tax kindly record for level 2, level 3, level 4, all entities. So this is applicable. This is applicable. What recognition exemptions are not applicable for level 4? So you need not do current tax, deferred tax for level 4, but level 2, level 3, you should disclose. Level 2, level 3, you shall disclose. Current tax assets and liability shall be set off with when the entity legally enforces right to set off or intends to settle the asset and liability on a net basis. So current tax assets and current tax liability, what does it mean is income tax payable and advance tax and TDS. You should set off in the balance sheet. Big deal we'll do. It's just you have to set off in the balance sheet. Next one is transitional provision. On the first occasion, when an entity gets classified as level 4 entity due to downgrade, the DTA or DTL reflecting in previous financial statements shall be adjusted against operating revenue reserve. So you'll be adjusting against P&L reserve or capital. So transitional provision is from level 3 you fall to level 4 or from level 2 you fall to level 4. These are the exceptions. So for only level 4, these exceptions are there. For level 2 and level 3, if you see DTA, DTL is fully applicable. Accounting for taxes for income, I told you fully applicable. Only level 4, there is an exception. Only level 4, there is an exception for AS 22. So that relaxation is current tax you need not record, deferred tax you need not record, nothing you can record in AS4. Small entities having turnover less than what? 1 crore. Having turnover less than 10 crores. Having borrowings less than 2 crores. Next one is relaxation of accounting standards for level 3 and level 4 entities. This relaxation is there for level 2 and level 3 only. Sorry, level 2 and level 3 entities. For level 4 entities, impairment is not applicable. I've already seen. For level 4 entities, impairment is not applicable. For level 2 and level 3, there is some relaxation. What is the relaxation for impairment of assets is? Generally in impairment, you will compare your cost with something called as fair value. You will compare cost with fair value. That fair value usually will be determined based on realizable value. How much I will realize in the market or value in use. What is value in use is on a future estimate how much value I am getting from that asset. Suppose I have this phone. How much value I am getting from this phone for the next few years. So every asset I will do this value in use. What I will do is how much income I can earn or how much benefit I can get from that particular asset. So I estimate what is my revenue or cash flow after tax from that particular asset and do discounting in present value. So I discount it, find my present value of that particular asset. I discount that asset and find the present value. For level 1 entity, you must do this. You must find value in use as well as realizable value. What is realizable values? If this phone is sold in an open market, what is the value of that phone? So that value is realizable value or value in use. You will be taking that value. You will be taking that value and comparing with my cost or WDV. If WDV is more than that, carrying amount you write off for impairment. For level 2 and level 3 entity, you need not find this value in use. AS 28 such as discount rate. So the relevant provisions of AS 28 such as discount rate is not applicable. Value in use you need not find. Disclosure for this, finding the value in use is not applicable in level 2 and level 3 entities. Also, Also, I just wanted to tell AS 26 also has an exception. What exemption is given is, it is given exemption only for level 4 entities. What exemption is given for AS 26 is financial statement should disclose the following for each of the class of intangible assets between internally generated intangible assets and other intangible assets. So you should disclose the following. So this exception is given. What reconciliation is given is a reconciliation between the beginning of the period and end of the period based on impairment losses. What are the impairment losses recognized for intangible asset? You need not record. Why I told impairment after impairment AS 26 is impairment loss relating to intangible asset, whether you're recognizing or reversing, you need not disclose the same as per for level 4 entities. For level 4 entities. Also, one more relaxation given for level 4 entity is generally it is encouraged to disclose the gross carrying amount for fully amortized intangible asset. Like your AS10, AS10 fully depreciated asset, you should disclose your gross carrying amount. AS26, it is encouraged to show. If you know the value, show the same. For level 4 entity, you need not show. For level 2, level 3, show the same. Level 1, level 2, level 3, show the same. Some disclosure exemption given for level 3 entities only. Level 3 entities, some more disclosure requirement is given generally. So AS4 is not applicable, AS28 is not applicable for AS28 is not applicable for level 4. So level 3 has some additional benefit. So generally impairment will be seen as a unit as a whole or an individual asset. It can be seen as a unit as a whole or an individual asset. So each period you will see impairment for individual asset or for cash generating asset as a whole. So what disclosure exemption is given is if an impairment loss for individual asset or a cash generating unit is recognized or reversed during the period and is material to the financial statements of that reporting enterprise as a whole, the enterprise shall disclose for individual asset. So for individual asset, you should have disclosed what is the reportable segment it belongs to. Since AS17 itself is not applicable for level 3, you need not show the same. You shall not show the same. So if an impairment loss for an individual asset or cash generating unit is recognized or reversed during the period and is material to the financial statements of reporting enterprises as a whole, an enterprise should disclose for an individual asset the reporting segment it falls part of. That disclosure requirement is exempted for level 3 because segment reporting itself is not there. You find reportable segment and all as good as you're doing additional work. So they have given a relaxation for the same. For a cash generating unit, you need not describe what is the CGU. So CGU is as good as a segment. So cash generating unit, you need not disclose the cash generating unit. Also, you need not disclose the amount of impairment loss recognized or reversed by class of assets and by reportable segment. So impairment loss for cash generating unit, you need not disclose by class of assets or reportable segment. Also, generally, it is encouraged for entities to show the assumptions to find the recoverable amount for assets during the period. That is exempt for level 3 entities. Last accounting standard, they have given some exemption. After this, non-corporate entities is not yet over. ICAI has given a technical guide for presentation of balance sheet and P&L in non-corporate entities. And I will also do a comparison between tax audit and accounting standards, where we are following, where we are not following. So the last point is in level 3 and level 4, level 2, level 3, level 4, there is some disclosure exemption. What are the disclosure exemption given is section para 66 and 67 of accounting standards are not applicable. So my dear members, also remember one thing. This relaxation was given to earlier level 3 entities. Impairment of asset, this relaxation was given to earlier entities. Lease relaxation was given to earlier entities, full lease relaxations. This relaxation was not given earlier. This relaxation was not given earlier in older accounting standards. So this relaxation was given in level 2 entities earlier. Level 4 impairment, level 3 earlier impairment was not applicable. Now level 2 and level 3 entities and level 4 entities, this benefit is given. Earlier for level 2 and level 3 entities, the same exemption was given. The same exemption was given. What were the exemption is? Movement in accounts. So you need not show the movement in accounts of provision. What is the opening balance of provision? What addition you made to provision? What deductions from provision? What is the unused amount during the year? This disclosure shall not be made. So carrying amount during the year, what additional provision you are making during the year, what amount you are using out of provision. For example, there is provision for audit fees. Opening balance 50 lakhs audit fees. Another 10 lakhs you are billing for, you are putting provision for the current years. So that it will come in your addition. Suppose the client pays 30 lakhs of audit fees. That will come in amount used. Amount used. Incurred and charged against the provision. Unused amount, which is reversed, is, for example, you waived off 5 lakhs audit fees in Corona period. So opening audit fee, you had 50 lakhs, additional audit fee 10 lakhs, 30 lakhs waived off, you will reduce, 5 lakhs waived, unused, you will reverse. I mean, 5 lakhs are waived off, you reduce, 30 lakhs paid, you will reverse. So two reversals you are doing, 30 plus 5, 50 plus 10 minus 30 minus 5. So you will be having audit fee of 25. That is the closing period. So that reconciliation you should do. Also for level 2, level 3, level 4, this is not applicable. For level 1, they should do. Also, one more relaxation given is enterprise should disclose generally the following information in relation to provision. Brief description of nature of obligation and expected timing of any amount resulting in outflow of accounting economic benefits. What are the indication of uncertainties about the outflow? Whether necessary to provide adequate information, enterprise should disclose major assumption made concerning future events. So suppose you have made a provision, if there are some uncertainties, what are the major assumptions you made regarding those future events you should record? Why you recorded provision, you should disclose. So that disclosure not required for level 2, level 3 and level 4. Any amount of expected reimbursement against the provision. And stating the amount of asset that has been recognized for the expected reimbursement, that also shall be disclosed. That you need not do for entity level 2, level 3 and level 4. So these are the exemptions given for level 1, level 2, level 3, level 4 entities. So we will see a quick table of what we have seen over the last 1.5 hours. So what relaxations have given? So AS1 is fully applicable for all the 4 entities. AS2 is applicable fully for all the 4 entities. AS3 is applicable only for level 1 entity. Those are having turnover greater than 250 or borrowings greater than 50. Other entities do not follow. AS4 is applicable for all entities. AS5 is applicable for all entities. AS7 is applicable for all entities. AS9 is applicable for all entities. PPE we saw applicable for 2 entities. Here there is relaxation. Here there is relaxation. I told you those encourage points, they have given some relaxation. AS11, the foreign currency management risk, they have given some relaxation. Government grant is applicable for all entities. AS13, I told you, statutory investments made need not be disclosed as per level 4, but be careful. SA you have to disclose means you have to disclose. Amalgamation applicable for 3 entities, not applicable for level 4. Employee benefit, you have certain exceptions. I told you. Disclosure for short-term accumulated funds, you need not show. Long-term benefits, you have to do only greater than 50 employees, you should do only projected unit cost, no other method. Discounting also done based on that. Less than 50 employees or level 4 entities, you need not even follow projected unit cost or discounting, just some rational method to create a provision. Borrowing cost, everyone should follow because of 3613. Segment reporting, only level 1 should follow. Level 2, level 3, level 4 need not follow. Because of that impairment, they have given benefit for level 3 and level 4. Related party disclosure, level 1 and level 2 should follow. Level 3, level 4 need not follow. But we will still report in tax audit report. We will see the differences between relative in AS18 as well as 48. Leases, I've given some disclosure exemption for level 2, level 3, level 4. For finance lease, that reconciliation between minimum lease payment and the present value of leases, also gross investment and present value of minimum lease payment, that for lessor, that reconciliation you need not show. Apart from that, you need not show the disclosure of lease that is to be payable within 1 year, 1 to 5 years, more than 5 years, or gross investment within 1 year, 1 to 5 years, and more than 5 years. So those relaxations are there. AS 20 is applicable only for level 1, level 2, level 3, level 4. It is not applicable. Consolidated financial statement is applicable for level 1, not applicable for level 2, level 3, level 4. Because LLP comes in body corporate. Why this comes in? LLP comes in body corporate definition. So that is the reason why this definition is there. Next one is AS 22, accounting taxes on income. Current tax provision you need not provide. Only that you need to provide. The deferred tax need not required. Then, so AS 22, it is given. So everything is exempt. Then current tax provision only you need to provide. Other than that, you need not apply in level 4. AS 23, only level 1 is applicable. Discontinuing operation first 2 levels, then it is fully not applicable. We saw AS 18 and 24 not applicable for level 3 and level 4. Interim financial reporting, all these exceptions. Here I told you some disclosure exemptions. So impairment and impairment reversal of intangible you need not show, whether self-generated or generated. Also that encouraged, if fully amortized, it is encouraged to show the gross carrying amount, that you need not disclose. Then financial reporting of interest in joint venture you can show. Other than that need not be shown. Impairment of assets, we have seen certain disclosure. Value in use you need not show. Discounting to present value you not show for level 2. Level 3 there are certain more exemptions. Level 4 in fact there is no exemptions. It's fully not applicable. AS 29 we saw what is the exemption for level. So the movement of provision and any asset, any expense reimbursement there, or any reversal, that reasoning we need not show. Apart from that, there are certain additional requirements which you need to be disclosing. So if an MSME is availing exemptions or relaxation, it shall disclose by a way of note to financial statements. So it shall disclose by a way of note to financial statements. So you have to disclose what are the exemptions. You have to disclose by what are the exemptions. So by way of disclosure, you should tell the fact that it is an MSME. What is the level of MSME? Whether you are a level 1, level 2, level 3 or level 4. Actually, MSME is only level 2, level 3, level 4. And it has complied accounting standards as far as level 2 entity or level 3 or level 4. So if you are following accounting standards as per AS1 disclosure, also your accounting standards disclosure, you have to tell how much you are following. Whether you are level 2, level 3, level 4, what much relaxation or exemption you have taken. Where an entity being covered in level 2 or level 3 or level 4 had qualified for any exemption or relaxation previously, but no longer qualifies for the relevant exemption or relaxation in the current economic accounting period, the relevant standards or requirement become applicable for the current year period only. The previous year accounting period shall not be revised. So generally, if an accounting policy changes, the previous year shall be revised. Whereas they have given a relaxation here. So earlier year, I was a level 3 entity. I become a level 2 entity. Earlier year, I did turnover of 45 crores. Now I'm doing a turnover of 55 crores. From 3 to 2, I go. Then the accounting standards change from level 2 and level 3. So related party should be disclosed in level 2, need not be disclosed in level 3. So you need not find last year's level 3 a related party disclosure, you need not do. You need not have a comparable figure. So last year figure need not be reversed, need not be revised. Just because it was level 3 last year and level 2 in the current year. So previous year figures need not be revised. Apart from that, the fact that it was covered, the fact that the entity was covered in level 2 or level 3 or level 4 as the case may be in the previous period, and it had availed certain exemptions or relaxations available to that level of entity shall be disclosed in the notes of accounts. So previous period, if you are level 3, just disclose that. You need not restate the figure, but just disclose. Last year it was level 3. That is why I need not follow related party disclosure. So that discontinuing operations disclosure. Also, you should disclose that the last year's figures have not been revised. That shall be disclosed. Even though you need not revise the last year figures, you should disclose. Previous year figures have not been revised on base of level 3 to level 2. So you have not revised to comparison. So that also shall be disclosed. All these disclosures shall be made. Also, no exemption or relaxation up to 2 years due to change of status. Suppose an entity is covered in level 1 and subsequently it falls. Here it has gained from level 3 to level 2, it gains. I told comparison. From level 1 to level 2, it falls. So it was covered in level 1 and subsequently it falls in level 2 or level 3 or level 4. Entity cannot claim exemption in the next year itself. The relaxation, the entity will not qualify for exemption or relaxation to that level until the entity ceases to be covered in level 1 for 2 consecutive years. So after being level 1 in 1 year, the next 2 years I should be, if I fall to level 2, say I am in financial year 21-22, I am a level 1 entity. Now in financial year 22-23, I fall to level 2. I should also be a level 2 in 23-24 to avail exemption, or else I cannot avail exemption. Similar is in the case of entity which has been covered in level 2 and it has fallen to level 3 or level 4, or what is covered in level 3 and subsequently fallen to level 3 or level 4. I mean level 4. So from 1 you have gone to 2 or 3 or 4, you have to wait for 2 years. From 2 you have gone to 3 or 4, you have to wait for 2 years. From 3 you have gone to 4, you have to wait for 2 years. Then only you can claim exemption, or else no exemption can be claimed. 2 consecutive years you should be the downgraded level. Because why they have given it is keeping Corona in mind. So a lot of entities in 2021, they fell. This application came in 2021. So the entity fell in 2021 means, so that is why they had given this particular benefit. Next one is voluntary compliance. What are the voluntary compliance shall be done by the entity? If an entity is covered in level 2 or level 3 or level 4 and opts to not avail these exemption, I will do cash flow statement. I will do related party disclosure. I told you AS 13, be careful, show the investment. I am doing that. Then you shall disclose that you have not availed that exemption. It is not, suppose you opt to avail, not to avail certain exemption or relaxation to that level of entity in respect of any, but not all of accounting standards, it shall disclose the standards in which it has availed the exemption or relaxation. So AS 13 or AS 3, I want to disclose. AS 3, AS 13, I want to disclose cash flow or investments. Other AS I am availing the exemption, I should disclose what all AS I am availing the exception. Also, even write a note what all AS you are not availing the relaxation. Suppose an entity covers in level 2 or level 3 opts not to avail one or more exemptions or relaxation to that level of entity, it shall comply with the relevant requirement of accounting standards. It must follow the relevant requirement of accounting standards. Next one, if an entity is covered in level 2 or level 3 or level 4, it may opt for availing certain exemptions or relaxation from compliance with requirements prescribed in an accounting standards. So I may choose certain relaxation, certain. So in one accounting standards, I choose certain relaxation I do not want to do. For example, in AS 29, I want to show the movement of provision, but I do not want to follow para 67. I want to follow para 66 showing the movement, very easy. That is not very difficult, but I do not want to show para 67. I can do that, but that disclosure shall not be permitted to mislead any person or public. So the users of financial statements should not be misled by following half relaxation and not following the other half of relaxation. So the above clause tells full accounting standards I want to follow or not. This clause is telling within the accounting standard whether I want to follow a clause or. Then the last thing, in respect of AS 15 employee benefits, certain level of exemption are given to level 2 and level 3 entities. For entities who are carrying more than 50 or more employees and less than 50, the requirements stated in paragraph 1 to 6 shall be applicable. Mutatis mutandis apply to this subclassification. So whatever relaxation you want to take for 50 or more or less than 50, you shall disclose. If you do not want to take the exemption, all the above disclosure shall be made. So 1 to 6 is 1, 2, 3, the previous page and this page, all the relaxation benefits. Next, for charitable organization. I am a charitable organization. Charitable organization are also non-corporate entities. They are also non-corporate entities. For them, accounting standards are applicable if they do commercial activity. If they do any commercial activity, accounting standards is applicable. So accounting standards applicable in respect of any enterprise, whether organized in corporate, cooperative or other forms, engaged in commercial, industrial or business activity, irrespective of whether or not it is profit oriented or whether it is established for charitable or religious purpose. Fully commercial activities, you have to apply accounting standards. If you are not doing any commercial activity, only donation you are collecting or giving relief to flood affected people, that you need not follow accounting standards. Sir, I am keeping interest on deposits. Whether deposit putting is a commercial activity, it's up to debate. So my safety is for every charitable organization, please follow accounting standards. Even a small proportion of activity you do commercial. So putting deposit is also commercial. You have to follow accounting standards in full. So partly commercial, partly non-commercial, full accounting standards will be followed. Now other key areas. I asked, what if I follow cash basis of accounting? I told you 3 fundamental accounting assumptions are there. One is going concern, accrual and consistency. Suppose I do not follow accrual system of accounting. What shall I do? According to IAS 1 disclosure of accounting policy, accrual is one of the fundamental accounting assumptions. The standard requires that if any fundamental accounting assumption is not followed, the fact shall be disclosed. In cases where statute governing requires the accounts to be prepared in accrual basis, but financial statements have not been prepared in accrual basis, auditor shall qualify his report. Auditor shall qualify his report. So Income Tax Act follows cash or accrual. You can follow cash or mercantile. Mercantile is as good as accrual system. So if there is a statutory requirement, like Companies Act, you have a statutory requirement to prepare in accrual basis, then you should qualify, or else you need not qualify. On the other hand, as per Income Tax Act, there is no statutory requirement to prepare the financial statements in accrual basis. So suppose the financial statements are prepared and on a basis other than accrual, the auditor should just describe in the audit report. So in your observation qualification, just tell that the basis of accounting followed is cash basis of accounting without qualification. It's just an observation. In paragraph number 5, you just write it as observation. So what disclosure you will write for observation? So I told in audit report you have to write some disclosure. What disclosure you can write is, it is the policy of the enterprise to prepare its financial statements on cash receipts and disbursement basis. On the basis, revenue and the related assets are recognized when they are received. So any revenue recognized or asset sold is recognized on receipt rather than when earned. And expenses are recognized when paid rather than when the obligation is incurred. In our opinion, the financial statement gives a true and fair view of the assets and liabilities arising from cash transactions of dash at dash date, and the revenue collected and expenses paid during the year then ended on cash receipts and disbursement basis as described in note number X. So in financial statements, you should give a note. The following cash basis, you should give a note. This note you should give and how much amount of cash receipts and cash paid. Apart from that, depreciation differs from AS 10 and Section 32. In Income Tax Act, you use ready to use, put to use, whereas AS 10 use available to use or ready to use. So you have to make sufficient disclosure. If you are following Income Tax Act, make a sufficient disclosure of the policy you are doing as per Income Tax Act. Even though there is a deviation, that impact shall be recorded in the notes to accounts. Suppose in notes to accounts they record the deviation, the opinion you can give a true and fair view. You can give a true and fair view. Also, I told you, tax audit report. 13, I told you that you specify the method of accounting. Mercantile means you're following AS1. Disclosure is fine. Cash system means you should show the disclosure what I showed. So these are the clauses which are relevant in tax audit in relation to accounting standards for non-corporate entity. So cash system means you should disclose it separately. Clause 13B and 13C, whether there is a change in accounting method, clause is in compliance with AS1, disclosure of accounting policy and compliant with fundamental accounting assumption of consistency. So if there is a change in accounting method, I told you consistency. Same thing is covered here. See, prior period item I told you is covered in 13C, that also you'll be disclosing. Any impact of change in consistency, that also you show in 13C policy. So 13C you show that. 13B you show, 13C you show if there is any change in policy, what is the impact? AS5 followed, AS1 followed. But what do? We do not disclose the same. In relation to ICDS, financial statement shall be prepared in relation to ICDS. We'll see the carve-in, carve-out for certain accounting standards. For example, ICDS 2 and AS2 itself, there is a difference. As per tax audit report, cost is valued at cost or net realizable value, whichever is lower. But if for ICDS 2 and 145A, you should value tax, you should value stock inclusive of taxes, whether refundable or not. As per accounting standards, you should not add tax. You can add tax only if it is non-refundable. If it is refundable or creditable, you cannot add tax to the stock value. So there is a difference between 145A and ICDS 2 with AS2. So reconciliation shall be prepared. So you will show your financial statement as per AS2 and then do a reconciliation as per ICDS 2. So there is a guidance note on tax audit where they have shown the computation for 145A. Kindly follow that. Kindly express your opinion based on that particular clause. So one more clause is AS18, I told you. So AS18, you have your clause. So apart from that, revenue recognition also, you should include your tax and all that. So 145A, that reconciliation, please prepare. Please prepare kindly. Please prepare kindly that reconciliation. Also, conservatism convention is not recognized as per ICDS 1, it is recognized in AS1. So that disclosure difference also you should show. Very oddly, they have not shown conservatism convention. And clause 23 of tax audit report has related parties. So what is reasonableness as per 48(2)(b) can be the arm's length price as per AS18. So if both are the same, that shall be disclosed. So with this, we finish our accounting standards. They have also shown a disclosure. So I'll just share the financial statements. So just like your Schedule 3 financial statements, for non-corporate entity, they have given a standard format based on a technical guide. So a technical guide was issued. For financial statements, a technical guide was issued. So if you want page number 14, this is there. So technical guide on financial statements. I have not shared this slide. So ICAI has a material called technical guide on financial statements of non-corporate entities. In this only, the accounting standards for non-corporate entities is mentioned. So who should follow, who should not follow? You can go to page number 30. So this level 1, level 2, level 3, all these exemption is given here only. So additional requirements, what are the accounting standards to be followed, what is applicable, not applicable, all these notes are given. How a financial statement shall be prepared is for a non-corporate entity is in the following manner. So same like your schedule 3. Basically, they've just copied schedule 3 and vomited out for non-corporate entity. This is technical guide. It is just a suggestion. It is just a suggestion. So suggestion to follow financial statements. It's up to you, the management of the company as well as the auditor to take it or not. So it is as good as schedule 3, like share of capital, you have owner's capital account, reserves and surplus, separate reserves shown, long-term borrowings, deferred tax liabilities, other long-term borrowings, long-term provision, same thing. Short-term borrowings, trade payables, micro and small and medium enterprises, total outstanding other than micro, small and medium. Observe one thing, schedule 3 has micro and small. Here it is micro, small and medium added. So most of the entities in India will be micro, small and medium. Other current liabilities and short-term provisions. Apart from that, property, plant and equipment, intangible assets. So you'll be recording all this. Tangible, intangible, capital work in progress, which is tangible work in progress, intangible under development. Non-current investments you will be recording. Deferred tax asset you will be recording. Long-term loans and advances, other current. They've just given schedule 3 omitted for non-corporate. And here they have not used cash and cash equivalents. You have used cash and bank balance because AS3 uses cash and bank balance. Current investment, inventories, trade receivables, cash and cash balance, short-term loans and advances, and other current assets. Same history. Brief about the entity. Tell some notes about the entity, what the entity does. Then show significant accounting policy. How do you follow the accounting standards? Then accompanying notes are relevant. So P&L is there in this format. Revenue from operations, other income, find the total income, cost of goods sold. So same thing. But there you have cost of materials consumed, then change in stock of work in progress. So raw materials consumed you will show separately. Change in work in progress, stock in trade and finished goods you will show separately. Whereas here just one cost of goods sold. Same employee benefits, finance cost, depreciation and amortization and other expenses. You see before extraordinary and exceptional items, before tax, then show discontinuing operations. Same thing you see schedule 3, you will have the same thing. No changes. No changes. Same thing. Beautiful this is. So you can standardize your practice itself. Prepare all financial statements of clients in schedule 3. Standardized practice. So owner's capital account, you have a name of, suppose it's partner, name of partner or one owner, full share of profit, what is the opening capital? Because in income tax return, as per section 139(9), you have to show the reconciliation of capital or else it will be a defective return. So beautifully you can present it in this way. Opening capital, add capital contributed, add what is the remuneration, what is interest. So based on this itself, you know 40B, what is the withdrawal, what is the share of profit, exemption under 10(2)(a), and then this. What is the closing balance? And reserves and surplus, you can show capital reserve, revaluation reserve, any other reserve, undistributed surplus, whatever is the accumulated surplus. Loans, you can show short-term loans, long-term loans. So secured, unsecured, basically whatever has been done. Security, guarantee, whatever you have seen in schedule 3, the same thing you are seeing here. Deferred tax net you will be showing. So deferred tax you will generally show on depreciation difference, book debts and this depreciation. Expenses which are disallowed but allowable in future year. Provision for bad debts which is allowed in 36(1)(7)(a), it will be disallowed. 36(1)(7) provision for bad debts is disallowed, allowed only when written off. So these are all deferred tax assets. You will reduce your deferred tax liabilities. Advance from customers, other long-term liabilities you will show. Then provision for employee benefit to follow your AS15. Other provision. So schedule 3, new schedule 3 format is exactly same. You just go and see. But here micro, small and medium, they are micro and small. So what is the amount unpayable, payable principal and interest? What is the MSMED? What this will be very useful for the department to find the new 43B given in the recent budget. So if you have not paid within the 45 days given in MSME Act, disallowance as per 43B. So this also has come for that particular purpose. Other current liabilities. So current maturities of long-term debts. But current maturity of long-term debts is given in that interest accrued not due, goods and service tax payable, TDS payable, unearned revenue. So income received in advance, unearned revenue is nothing but income received in advance. They've given it two different items. Property, plant and equipment beautifully show gross block, net block, depreciation. Beautifully intangible asset, gross block, net block, depreciation. But see, tangible, they have given everything. Intangible also they have given goodwill, brands, computer software, mining rights. So beautifully you can present your financial statements. Bankers also, it will be much beautiful. What are the capital work in progress record the same. Investments, what are quoted, what are unquoted, what are the opening numbers, what are the previous year numbers, face value. So all these you can record. Whether traded, untraded, current maturities of long-term investment, all these disclosure you can do. Whatever is there in Schedule 3, the same thing has come. Loans and advances, long-term and short-term, they have grouped it together. Other non-current assets, security deposit, prepaid expenses, you can show together. Inventories, trade receivables, cash and bank balance, current account, CC with debit balance, that is CC in bank account credit, in books of accounts debit balance. Fixed deposit, which are with original maturity, then earmark deposits also you can show, margin money deposit you can show. Any interest accrued on deposit in other current assets. So revenue from operations, same sale of product and all that, interest, other revenue, cost of raw material, consumed inventory, beginning of the year, add purchases, less inventory. So beautifully they have given the presentation. So raw material separately, packing material separately, other material separately, stock in trade separately, work in progress separately, finished goods separately. Beautifully they have given. Increase or decrease, totally you get your cost of materials, cost of goods. Schedule 3. Just to do Schedule 3, you can do for non-corporate. Technical guide has told, come on, let's do Schedule 3 even for non-corporate. So salaries, bonus, gratuity expenses. So if you show gratuity expenses, AS 15. Finance cost. And then depreciation, tangible and intangible, refer the notes. Then all this consumption, repairs, maintenance on building. Why they have given this separately? 30, 31. Income Tax Act, insurance also you can show separately. Labor charges, traveling expenses, auditors remuneration. So auditors remuneration you can split for taxation, for which audit, for consulting, all that, plant and machinery. So all these disclosure, beautifully you can present the same. So I have shared all the materials which are there as resources. So accounting standards for non-company, they have given compendium of accounting standards, what is followed for accounting standards, quick referencer for companies, quick referencer for micro non-corporate entities, there's a disclosure. And this model financial statements and this technical guide, I have given a disclosure. With this, I will end the session. The floor is all yours for asking any doubts. If there are any doubts, please do ask. On this note, I will end today's seminar. So those who are having any doubts, you can ask based on level 1, level 2, level 3, level 4, or anything relating to peer review, because mandated peer review is applicable. You have to do peer review before 31st March. So 1920, you have to follow the old level 1, level 2, level 3. 2021 and 21-22, you should follow the new level 1, level 2, level 3, and level 4. Thank you. Those who are having any doubts, Q&A No open question.
Sorry, any questions? You can ask the sir. Sir will clarify the doubt. You can. So, no any questions, I think, sir.
Okay, we'll end the session, sir.
Yes, thank you, sir. Thank you for conducting the online session on valuable topic of accounting standards and for non-corporate entities. Thank you, sir.
Thank you.
Thank you, sir.